Something is happening beneath the surface of the global financial system. Something most people will not notice until it is too late. 3 signals, 3 institutions, 3 warnings: COMEX, Fort Knox, CPI. Each one on its own might mean nothing, but together, they may be telling a story that very few are prepared to hear. A story about currency, about trust, and about what happens when a nation's paper promises begin to outweigh what is actually sitting in its vaults. By the end of this video, you will understand exactly why serious investors, central banks, and even entire nations are quietly repositioning themselves right now. Before the next move happens, stay with us. Welcome back to Precious Metals Intelligence, the channel dedicated to helping serious investors, business professionals, and strategic thinkers understand the economic forces shaping the world's monetary future. If this is your first time here, thank you for joining us. And if you have been with us for a while, welcome back. Your presence here means a great deal. Before we begin, we would like to know, where are you watching from today? Please take a moment to share your city or country in the comments below. It always means a great deal to see just how far this community truly reaches. Now, let us begin. For decades, most people did not think much about the money in their wallets. A dollar was a dollar. It bought groceries. It paid the rent. It felt solid, dependable, permanent. But somewhere along the way, that quiet trust began to crack. And once people start asking questions about their money, history shows that the answers rarely come without consequences. To understand what is happening today, one must first look back. In 1971, the United States made a decision that would quietly reshape the next 50 years of economic history. The dollar was separated from gold. No longer would every dollar in circulation be backed by a fixed amount of precious metal sitting in a vault. From that moment forward, the value of the dollar would rest on something far less tangible: trust. Trust in government, trust in policy, trust that promises made on paper would hold their worth over time. For a while, that trust held. The United States enjoyed decades of global economic dominance. Its currency became the standard by which the rest of the world measured value. Oil was priced in dollars. Trade was settled in dollars. Nations held dollars in reserve, believing them to be as good as gold itself. It was, by almost every measure, a position of extraordinary advantage. But advantages, when left unchecked, can quietly turn into liabilities. Over the following decades, the government did what governments under pressure often do. It spent, it borrowed, it printed. Deficits became a permanent feature of the national budget, not an occasional necessity. And each time more dollars entered the system without new value to support them, the ones already in circulation became worth a little less. Slowly, quietly, almost invisibly, year after year. Today, that invisible erosion is no longer invisible. Prices at the grocery store tell the story more clearly than any economist could. The cost of basic goods, food, housing, and everyday essentials has climbed sharply in just the last few years. Officials often describe this as affordability pressure. Economists call it something simpler: inflation. And inflation, at its core, is not really about prices rising. It is about currency losing its power. This is the quiet storm building beneath the surface of the modern economy. It does not arrive with sirens or headlines. It arrives gradually, through smaller paychecks that buy less, through savings accounts that quietly lose ground, through a slow and steady transfer of wealth from those who hold cash to those who hold something else. And this is precisely why precious metals have re-entered the conversation. For thousands of years, long before modern currencies existed, gold and silver served as the foundation of trade and wealth. They could not be printed into existence. They could not be created by a decision in a government meeting. Their value came from scarcity, from labor, from the simple fact that there would only ever be so much of them in the world. When paper currencies begin to lose credibility, history shows a consistent pattern. Investors, institutions, and even entire nations begin looking for something that cannot be devalued by policy alone. They begin looking for something real. This is not a new phenomenon. It has happened before, in different countries, under different governments, across different centuries. Currencies rise, currencies fall. But gold and silver have remained quietly as the anchor that outlasts every paper system built around them. What makes the current moment different is the scale. The debt levels being discussed today are not measured in millions or even billions, but in trillions. The pace at which that debt is growing is accelerating, not slowing. And the tools available to address it are becoming more limited with each passing year. This is the backdrop against which everything else in this story must be understood. The renewed attention on Fort Knox, the unusual activity taking place in the COMEX markets, the upcoming inflation data that could move markets within hours of its release. None of these events exist in isolation. They are all connected threads in a much larger pattern, one that has been quietly forming for years and is now beginning to demand attention. In the next part of this story, the focus turns to Fort Knox itself, and to a question that is being asked more seriously than at any point in recent memory. Is the gold that is supposed to be there actually there? And why, after so many decades of silence, is this question suddenly being asked out loud? There is a room, buried deep beneath layers of concrete and steel in the hills of Kentucky, that very few human beings have ever entered. For generations, it has existed more as an idea than a place, a symbol, a promise, locked behind vault doors and armed guards that somewhere in the heart of America, real gold still sits in real storage. But lately, a strange and uncomfortable question has started spreading across dinner tables, financial forums, and even the halls of government. What if that promise has never truly been checked? This question is not coming from conspiracy theorists on the internet. It is coming from elected officials, financial analysts, and everyday citizens who are beginning to notice something unsettling. In a nation that audits corporations, tracks every dollar of public spending, and demands transparency from banks, the gold reserves, said to anchor the country's financial credibility, have gone largely unverified for decades. Recently, that quiet unease turned into public action. A sitting United States senator made the trip to Fort Knox himself, descending into the facility to see the gold firsthand. It was, on the surface, a moment of reassurance. Cameras captured him underground, standing near stacks of gold bars, confirming that yes, the metal appeared to be there. But the visit raised as many questions as it answered. The senator's time inside the vault lasted only a few hours. Critics quickly pointed out that a brief walkthrough is not the same as a full, independent audit. Officials could visually confirm that gold bars were present. They could not verify the purity of every bar, the exact weight of every holding, or whether the total matched official government records down to the ounce. Some began calling it, only half-jokingly, an eyeball audit. And yet, despite the informal nature of the visit, something important happened. For the first time in a very long while, a national conversation about America's gold reserves entered the mainstream. People who had never before thought about Fort Knox were suddenly asking basic, fundamental questions. How much gold is actually there? When was it last independently verified? And why does it matter so much right now? The answer to that last question lies not in the vault itself, but in what the vault represents. Fort Knox is often described as holding roughly 147 million ounces of gold, with close to half of the nation's total reserves stored at that single location. On paper, this remains one of the largest sovereign gold holdings on Earth. But holdings only matter if people trust that they are real, accurately reported, and properly accounted for. This is where the deeper story begins to take shape. The senator who visited Fort Knox did not stop at the topic of gold. He connected it directly to something far larger, the value of the American dollar itself. Since the United States severed its currency from gold in 1971, he noted, the dollar has lost the vast majority of its purchasing power. What once bought a full basket of groceries now barely covers a fraction of the same items. This is not a matter of opinion. It is a matter of long-term economic record. The connection here is simple, but powerful. A currency backed by nothing but trust requires that trust to remain intact. And trust, once questioned publicly by the very officials meant to safeguard it, becomes much harder to fully restore. When a senator feels compelled to travel underground and personally inspect a vault, it signals something important. It suggests that even those inside the system are beginning to wonder whether the foundation beneath it is as solid as it has always been assumed to be. This is not about panic. It is not about assuming the worst. It is about recognizing a pattern that history has seen before. When institutions that were once taken for granted suddenly require public reassurance, it is rarely because everything is functioning exactly as expected. Confidence does not need audits when it is unshaken. It only requires proof when doubt has already begun to creep in. And doubt, once it enters a financial system, tends not to leave quietly. It spreads from senators to analysts, from analysts to investors, and eventually from investors to the general public. Each new question adds another small crack to a foundation that, for over 50 years, was rarely examined at all. In the next part of this story, the focus shifts away from vaults and government buildings and toward the trading floors, where enormous volumes of gold and silver change hands every single day. There, a very different kind of imbalance is quietly taking shape, one that may reveal just how fragile the physical supply of these metals has truly become. Somewhere in the world, every single day, more silver changes hands on paper than most mines could produce in months. It happens quietly, through screens and contracts, far away from any physical vault or mining operation. And yet, the numbers involved are so large that once someone actually stops to calculate them, the scale becomes almost impossible to ignore. This is the story of COMEX, the commodity exchange, where much of the world's gold and silver trading takes place. To most people, it is an unfamiliar name. Tucked away in financial headlines, they scroll past without a second thought. But for those who study precious metals closely, COMEX has become the center of a growing and uncomfortable question. How much of the silver and gold being traded there actually exists in physical form, ready to be delivered? And how much of it is simply a promise on paper? Consider the scale of what happens on an ordinary trading day. In a single 24-hour period, it is possible for more than 300 million ounces of silver to be traded on paper contracts. To put that number into perspective, the entire global mining industry produces roughly 800 million ounces of physical silver across an entire year. In other words, in one single day, paper trading can represent more than 1/3 of everything the world's mines will produce in 12 full months. This is not a small imbalance, it is a staggering one. Most of these trades never involve anyone actually receiving physical metal. They are financial contracts, bets on price movement, settled in cash rather than silver bars or coins. This is normal in modern commodity markets, and by itself, it is not necessarily alarming. But when the volume of paper trading grows so large that it dwarfs actual physical supply many times over, it raises a deeper question. What would happen if a much larger share of traders suddenly demanded real physical delivery instead of a cash settlement? To understand why physical supply cannot simply expand to meet demand, one must look at what has happened inside the mining industry itself over the past several decades. For many years, silver mining companies struggled to remain profitable. Prices were often too low to justify the cost of large-scale expansion. Rather than shutting down entirely, many mining companies adopted a strategy known as high grading. This meant focusing only on the richest, most valuable ore, while leaving lower-grade deposits untouched. It kept companies alive in difficult years, but it also meant that some of the easiest, most accessible silver in the world has already been extracted. At the same time, a quieter shift was taking place across the mining sector. A number of companies that once identified primarily as silver producers gradually pivoted toward gold instead. Gold offered more stable pricing and stronger margins, making it a safer business decision. As a result, some of the very companies the market once relied upon for silver production slowly transformed into gold-focused operations, further tightening the future pipeline of silver supply. The consequence of these decisions is now becoming visible. Even as demand for silver continues to rise, driven by industrial use, investment demand, and renewed interest from everyday buyers, the ability of mining companies to significantly increase output remains limited. Expanding a mine, opening a new one, or processing lower-grade ore all require years of investment, planning, and infrastructure. Supply cannot simply be turned on like a switch, no matter how strong demand becomes. This creates a widening gap between what is being promised on paper and what physically exists to back it. Analysts who study this imbalance describe it as one of the most important, yet least discussed, structural weaknesses in the modern precious metals market. As long as most participants are content to trade contracts without demanding physical delivery, the system continues to function smoothly. But confidence, once again, becomes the deciding factor. If enough participants begin to doubt whether physical metal will truly be available when needed, the pressure on this paper-to-physical relationship could intensify rapidly. This is not simply a technical detail for traders and analysts. It speaks to something much larger, a market where enormous financial promises rest on a physical foundation that is far smaller and far more constrained than most people realize. In the next part of this story, attention turns to a single number set to be released to the public very soon, one capable of moving markets within minutes of its announcement. It is a number tied directly to inflation, and it may reveal just how much pressure is building beneath the surface of the entire financial system. Tomorrow, a single number will be released to the public. It will take only a moment to read. Most people will glance at it, form a quick opinion, and move on with their day. But for those who understand how deeply this number reaches into the financial system, it carries far more weight than its brief appearance in the headline suggests. That number is the Consumer Price Index, more commonly known as CPI. It is meant to measure something simple on the surface: how much prices for everyday goods have changed over time. Groceries, housing, transportation, healthcare, all of it gets folded into a single figure, reported by the government and scrutinized by investors around the world within seconds of its release. Analysts currently expect this month's inflation figure to come in near 3.4%. It is a number many have already priced into their expectations. But numbers on paper and numbers in reality do not always align, and the space between those two outcomes is where real market movement tends to happen. If the figure arrives higher than expected, the reaction is likely to be swift. Higher inflation suggests that prices continue rising faster than policymakers would prefer, which often leads to expectations of tighter monetary policy. In the short term, this can place downward pressure on precious metals. As investors adjust their expectations around interest rates and the strength of the dollar, it would not reflect a change in the deeper structural story building beneath the surface. It would simply reflect short-term market mechanics reacting to a single data point. If the number comes in as expected, or even slightly lower, the market reaction could move in the opposite direction. A softer inflation reading often eases concern about aggressive policy tightening, which can support demand for gold and silver as investors look for stability outside of traditional currency systems. Here, an important distinction must be made. Whatever this number reveals tomorrow, it does not change the broader forces already explored throughout this story. It does not undo the questions being raised about Fort Knox. It does not shrink the widening gap between paper trading and physical supply on COMEX. It is, in the truest sense, short-term noise layered on top of a much longer-term signal. Yet this is precisely why CPI deserves attention, not because it defines the future, but because it tests present confidence. Each release becomes a small referendum on whether the official narrative around inflation matches what people are actually experiencing in their daily lives. And increasingly, many are noticing a gap between the two. Official inflation figures often describe a controlled, manageable pace of price increases. Meanwhile, the cost of basic groceries, housing, and everyday essentials has climbed by a noticeably higher margin over the past several years, based on independent analysis and consumer experience alike. This growing gap between official data and lived experience is not a minor detail. It is central to understanding why more people, from individual households to major financial institutions, are quietly reevaluating their trust in paper currency systems altogether. When a measurement designed to track reality begins to feel disconnected from reality itself, confidence erodes, slowly at first, then more visibly over time. This is the environment in which tomorrow's CPI report will land. Not as an isolated economic update, but as another test of a system already under strain, already facing renewed questions about its gold reserves, and already showing signs of imbalance between paper promises and physical assets. Taken individually, CPI, Fort Knox, and COMEX might each seem like separate, unrelated stories. Taken together, they form a much larger and more urgent pattern, one that becomes impossible to ignore once properly understood. In the final part of this story, all three threads will be brought together, revealing why so many analysts, investors, and even entire nations are positioning themselves now before the next major shift in the global financial system begins to unfold.